Well, folks, apart from learning the fact that Jerome Powell makes around $190,000 a year being chairman of the Fed, we learned a lot about the real status of inflation last week. This is leading many investors to question the current state of the stock market rally and whether or not the Fed has any motive to rug pull us going into the summer with a 50 basis point hike. What would actually be the reasoning behind such a rug pull, and how would it affect both the stock market and the economy? That is exactly what I want to discuss in this video. But as usual, guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. Yeah, believe it or not, Jerome Powell makes just under $200,000 a year being chairman of the Fed. I'd say that's a fair salary, but given the amount of stress this one individual is under, controlling most financial markets in the US, which is obviously the biggest economy in the world, I think he might just deserve a little bit of a raise. But anyways, the real talk of last week has obviously been around CPI and PPI, which both came in much harder than expected, and a retail sales data which came in much stronger than Wall Street had priced in. Because of how strong the economy's been so far and the fact that we have not seen a negative GDP print, people are expecting the Fed to now raise all the way to 5.5% by the end of this year. And I hate to say it, but that is an extremely flawed way of thinking about the situation. Even if investors priced in a faster decline in inflation, there is no arguing the fact that inflation is coming down. Even if you look at the manufacturing side from the producer price index, which always tends to be leading the CPI, we have fallen significantly from the heights we saw in March and June of last year. This right here is the definition of inflation falling. Just because analysts got the real inflation data wrong does not mean the story is any different. The Fed's job is being done. Interest rates are bringing down inflation in not only the consumer-driven areas, but also those driven by businesses. Even if on a month-over-month basis we rose by around 50 basis points, we are still way off from the extreme peaks we saw throughout 2021 and 2022, north of almost 1% month-over-month. We are way better off than the inflation that we saw last year, which is exactly why markets are not reacting in as bad as a way as many people expect it to. Yeah, the 10-year yield is starting to creep up a little bit, but it's not creeping up anywhere near the pace it was throughout 2022. And this is something investors don't truly understand about the situation of the market today. The reason we were in a bear market last year was not because inflation was high, but because inflation led to the Fed being the most aggressive it has ever been in 40 plus years. That's what the S&P 500 was trying to price in, as people timed what the Fed would do ahead of time. Markets collapsed in January, but the first interest rate hike did not happen until March. As the Fed started raising at a faster pace with bigger increments, the bear market obviously got deeper. But now that we're kind of going to the end of the rate hike cycle with only 25 basis point hikes, the market again is front running what the Fed is doing, just like it did in early 2022. People need to realize the fact that most of the damage from bond yields has already been done. We're already seeing car prices and house prices collapse on a year-over-year basis. The trend is shifting, inflation's falling, and the US economy is not going in as deep of a recession as many people expected. You see, this is the first time in recent history that we're seeing the stock market lead earnings forecast projections on a year-over-year basis. As you can see, back in 2015 and 2016, earnings forecasts first started to fall over, and that's when the stock market started to roll over. We saw a similar thing here in 2005 and 2006 as earnings forecasts started to decline and stabilize, and then we saw the inevitable crash in the global financial crisis. We saw a very similar thing happen in 2001 as well. As earnings forecasts declined, the stock market declined. But here in 2022, the stock market actually went down first, and then earnings forecasts started to decline on a year-over-year basis. We had such strong growth throughout the past 2 years that the market is now just self-correcting onto the same path. Remember, the line here in yellow is not the actual real value of earnings, it's just the growth rate on a year-over-year basis. And as you can see, like in 2018, when markets lead what earnings are doing, markets actually tend to rally during times of overall earning declines. Because yet again, it's just a correction back to the normal. And for those folks that are in disbelief of the rally we've seen for the past 2 months, keep in mind that global liquidity levels are rising at an insane rate. Japan and China have injected so much money into their own economies that it's having a ripple effect on other economies in Europe and North America. Those countries are way ahead of the US in their economic cycles, where they're currently coming out of a recession and are actually stimulating their economies. The US, on the other hand, is behind because we obviously injected so much money already in 2020 that the recession we're facing today is basically non-existent. Meaning even if we get a recession in 2023, we're not going to be cutting interest rates and stimulating growth until at least next year. And even though share buybacks are nowhere near the levels of 21 and 22, we're starting to see a nice and healthy uptick over the past few quarters, telling us that companies actually have a lot of excess cash on the sidelines and see value in their own equities, unlike in 2020. This doesn't necessarily mean the market's going to bottom immediately, but it is a healthy sign that companies themselves see value in their own stocks, which obviously is dependent on their financial situation. If they really expected the next few quarters to be a bad time for business and the economy, they would obviously not be doing buybacks like they are right now. And even though, yes, there are good arguments saying that US buybacks are often a good contrarian indicator of what's going to happen in the stock market, as most companies do a pretty bad job at buying back their stock, I think the trend of this chart is much more important than the face value. We already saw that capitulation in buybacks from the second quarter to the third quarter of 2022 as earnings collapsed and companies realized they had to cut back on spending. But this is the first time we're seeing an uptick in buybacks from the last 2 quarters. This obviously isn't a confirmation of a trend, but it is a bullish signal on the state and health of the economic situation. And if you pair that with the fact that a record number of Americans still expect markets to do poorly over the next 6 months, I would say there's a very high likelihood we have bottomed in October, and you should still be using this time to average into your own companies and index funds if you haven't done so. Because again, waiting to time the market is the biggest mistake you will ever make as an investor. And why do I believe that? Well, as you can see, even during times of higher interest rates and a potential situation where the Fed rug pulls us and raises rates by another 50 basis points, it does not necessarily mean the market is going to go down. There's this very weird notion in the market that interest rates going up is inversely correlated to what the stock market is going to do. But in actual fact, that is completely false. As you can see, from 2015 all the way up to 2019, interest rates were being raised from 17 all the way to 250 basis points, yet the stock market rallied by more than 60%. A similar situation happened between the dot-com bubble and the global financial crisis. The Fed cut rates into the recession of the bubble and then started raising rates, all while the stock market gave us insane returns of more than 89%. And like I said, most of the damage by interest rates has already been done. We've already raised by the insane chunks of 50 and 75 basis points, which were supposed to do the biggest damage to the economy and bringing down inflation. An extra 25 basis points is not going to affect what investors think about market valuations, which is a big reason for the strength we've seen throughout January and February. The 10-year and 2-year yields are no longer driving the markets, as we're starting to see a separation between their performance and what stocks are doing. And this is exactly how the market is designed to work. At the end of bear markets, Fundamentals completely detach from reality because markets are always forward looking. So even if you hear a lot of talk about this new interest rate hike, maybe in September or November of this year from the Fed, keep in mind it's not going to have a big effect on the market if it's already being discounted today. It might have a real effect on the economy and the way people spend money, but at some point, markets are going to stop reacting to that news. And that has historically always marked the bottom. I mean, what did you think the news looked like in April and May of 2020? We still saw record COVID deaths, and we had no vaccine, and people had to mask up to go outside. This was obviously not a good economic situation, yet the market rallied more than 50% from its lows. Just because the news is bad does not mean markets have to go down, because at some point everything gets priced in. And right now we're seeing a very similar situation, even if obviously the situation outside does not look that good. I can't predict what the market's going to do for the rest of the year, and there could be a black swan event that causes markets to go down even further. But based on the current data, where GDP data is coming in stronger, retail sales are showing a healthy economic situation, and inflation is falling, the market has plenty of room to run to the upside if the situation stays put. But as usual, guys, that is just my take on the situation. So let me know your thoughts down in the comment section below.